Kitco News, special coverage of the New Orleans Investment Conference, is brought to you by Uranium Energy Corps and U.S. Gold Mining.
Welcome back to Kitco News on location at the New Orleans Investment Conference. I'm Jeremy Szafron. You know, the big question here is, did we already see the last Federal Reserve rate cut in this easing cycle? And with inflation going up and Donald Trump coming into the office, could we see rate cuts into next year? Here to weigh in on all of this is George Gammon. George is a renowned investor, macroeconomic expert, and of course, the host of The Rebel Capitalist. George, great to have you on. Good to see you.
It's good to be here. Thank you for inviting me.
A crazy time to be alive. I mean, we're watching all-time highs. We were just discussing it. Bitcoin might even cross over that 100,000 mark. Yeah. But before we get into that, and gold, we got to talk about the debt problem. You know, I've been highlighting it here. We have this upcoming FOMC meeting in December. We've already seen a dramatic cut from 50 basis points, another 25. Markets kind of split. CME Fed Watch Tool saying 50% they're going to stay, 50% they're going to cut. But let's talk about the inflation being sticky. I mean, in October, we not only had sticky inflation, but CPI is up. What does this mean for the FOMC going into the meeting in December?
Well, what I think people need to do is take a moment, zoom out, look at history, right? So we tend to forget that in 2007, the Fed cut by 50 basis points. It was actually on the exact same day, September 18th. And what you saw during that first, or at that first rate cut, is CPI running at around 3.5%, if my memory serves me well. And then what they did is they cut another 25. They cut another 25 just that year, right? And then going into 2008, they're supposed to have a meeting January 29th. They actually had an emergency meeting January 22nd because things got so bad, where they cut by, I believe it was 75 basis points. And then a week later, they cut by another 50 basis points. So these massive interest rate cuts, okay? Now, during that time, what was happening as far as the narrative is people were saying that they're cutting too much. Inflation is going to reaccelerate, which oddly enough it did. So if you look at that first rate cut, 3.5% in the CPI, and we can debate whether that's accurate or not, we're just looking at the trend. If you fast forward to August of 2008, the CPI went from right around 3.5% up to 5.6. 5.6. And this was August of 2008, all right? So then if you read the Wall Street journals around that time, which I like to do, I like to go back and read the old Wall Street journals. When the CPI report came out in August for July and it printed the 5.4, 5.6, what the narrative was back then is the Fed is going to have to start hiking rates. So going into the end of the year, they've made this huge mistake. They're way off sides. They cut interest rates way too low because they're afraid of the boogeyman. The economy isn't doing that bad, even though the stock market went down. So now they've let the inflation genie out of the bottle, so to speak. And now we've got to worry about not disinflation or deflation, but we've got to worry about a reacceleration of consumer price inflation because the Fed has totally lost control. And oh, by the way, the 10-year Treasury yield from that time in January 22nd to August, it went up. It went up. So they're saying, look, the Fed has lost control of the long end of the curve. And the biggest concern that we have is a reacceleration of consumer price inflation. This was August of 2008, and I'd like to remind the viewers that just 2 or 3 months later, interest rates were at zero. And you fast forward about a year, and the inflation rate was -2. In other words, 2% deflation, not even just disinflation, deflation, right? So what I'm saying is, I'm not using that example to predict and say we're going to see the exact same thing in 2025 that we saw in 2008. But what I am saying is just because we see interest rates along the curve go up after the Fed cuts, and just because we see the CPI go from 2.4 to 2.6, doesn't necessarily mean that there's 100% probability that we have let the inflation genie out of the bottle. And then if you go back to 2001, you see that to a lesser degree, we saw the same cycle, that once the Fed cuts rates, the 10-year Treasury yield actually goes up. It doesn't usually go down for quite some time. But then what happens is what the yield curve is predicting, that usually over the next year or year and a half plays out once the Fed starts cutting rates. When you look at the yield curve, the crash or the recession, or whatever you want to call it, the hard landing, it rarely occurs when the curve is actually inverted. It usually occurs after the Fed starts dropping rates, and that's what makes the curve steepen out and uninvert, and that's when the stuff usually hits the fan. Usually. Now, it could be different this time. It absolutely could. But what I like to do is just go back and look at these cycles, going back to the 1950s, and say, okay, 95% of the time, let's say it plays out this way. So in this business that we're in, there are no certainties, there are only probabilities. But what we have to see is that it usually plays out this exact same way, and the end game, if you just fast forward a year or two, is very rarely a reacceleration of consumer prices. It's usually disinflation that's then followed by an acceleration of inflation due to the response mechanism from the central planners. So that's my base case right now, and that's just based on what has happened over the past cycles.
Yeah, a lot of analysts are questioning, they almost have to cut. I mean, can the Fed even afford not to cut at this point?
Well, I think what you have to ask is, why did they cut in the first place? Like, why did they cut 50 basis points? It's not because the economy is booming, and I get it. They're no more focused on unemployment as opposed to inflation, but they're doing that because growth and inflation expectations are declining. You look at the SOM rule. I'm sure you guys talk about that all the time.
Yeah, we had Claudia on.
Yeah, I mean, that's a great indicator as to just that in and of itself. Look, when you see that go up by 50 basis points or whatever it is, you're usually very close to, if not in a recession. So it's not just that. If that was just the only indicator that we had, I'd say, okay, well, maybe it's wrong because of X, Y, and Z. But you look at that, you look at the inversion of the curve, you look at all these other things. I mean, even the wildest bull that you guys have on your channel would sit there and say that the poor and middle class is doing well right now. There's no way. You cannot argue that, right? So then it becomes, well, why is the upper class, why are they doing well? Well, it's because of asset prices. Okay, so what you're telling me is the entire U.S. economy is built on asset bubbles.
Yeah.
And yes, those bubbles may be able to continue into the future, but they can't continue indefinitely into the future, right? So then you have to say, okay, what is the pin that's going to prick that bubble to where it'll impact the aggregate demand of those people at the top to where they join the poor and middle class, and then that's usually when you see a recession. It doesn't mean you have an absolute crash like the GFC or during COVID or something like that, but you just see a balance sheet recession that may be very similar to what we saw in 2001. But oh, by the way, the Fed dropped by 50 basis points to start that interest rate cycle as well.
Okay, well, you and I chatted a little bit off camera just about how crazy it's been culturally. There's been a big shift. So Trump has come in, there's talk about DOGE, there's talk about efficiency, cutting costs. Nobody really ran on a mandate to decrease debt. What are your thoughts here? How has it changed?
Well, on that note, I'm very bullish. So you can have reasons for being bearish and bullish, and it's all about net balance. Right? So, I'm very excited, at least from a cultural standpoint, like you said, I'm very excited because what I'm just observing, doing all my videos and being neck deep in the news every single day, is we've gone from, just a simple example, we've gone from the football players taking a knee during the anthem, saying how it's basically cool to be a victim, right? To now the football players are in the end zone doing the Trump dance. Right, which for me just indicates that there's been this big shift culturally in the United States where it was cool to be a victim, but now all of a sudden it's cool to be successful. And maybe we can extrapolate that, I'm hoping we can, to it was cool, big government was cool. It was cool for the government to take care of me because I was a victim. But now all of a sudden, well, maybe that's not cool. Maybe I better take personal responsibility. And maybe we need to understand how inefficient this bureaucracy is that is the federal government. And maybe it's cool to start shrinking that. And that's what we need. It reminds me, I was very young, going into the 1980s, but it reminds me of kind of that Thatcher era or Ronald Reagan. And the proof that I would give to you is watching like Elon on Joe Rogan. Where 3 or 4 years ago, Joe Rogan was talking about how, we should expand government through Bernie Sanders and this and this and this. And now all of a sudden he's getting on there with Elon, and Elon is really influencing him to look at it from a different standpoint, that we need to shrink the size of government, and that's actually the path forward. And Joe Rogan obviously has a massive, massive audience, huge influence, right? And so when you have all these younger males that are watching Joe Rogan, looking up to him and he's saying and agreeing with Elon, and then they're rethinking it and saying, well, man, maybe all these things that my teachers taught me about socialism, maybe that's not the best path here. Maybe that's not the best thing that we need to do. And so for that reason, it's all about net balance. But for that, looking at it through the lens of culture, I'm very, very excited about what we have in the United States because, and I go into this in my presentation, I don't think we have a debt problem. And that's probably...
unpopular opinion?
Yeah, that's probably a little bit different than most of your people that you interview. The reason I say that is because we look at interest rates right now, and we've got the 10-year trading under Fed funds still, even though the 10-year has gone up. If we had a debt problem, that would be reflected in interest rates. If Fed funds is at 4.5%, and we had a debt problem, meaning that we've got all this supply that's coming on, we have all this demand that's deteriorating because all these foreigners are dumping treasuries, and they look at the off-balance sheet liabilities or whatever, and they say there's no way I want to hold treasuries anymore. The interest rate on the 10-year would not be under Fed funds. Right. It would be 8%. It would be 9%, right? So since you have an inverted yield curve, that in and of itself tells you that there's massive demand for treasuries. Just look at the price. Don't take my word on it.
Yeah. I mean, one could argue that China and Japan just dropped billions, hundreds of billions of dollars of treasuries, but was it strategic? Yeah.
Who picked it up? All the banks in the Cayman Islands. Right? And why did they pick that up? Because what really matters to interest rates at the long end of the curve isn't necessarily supply. This is where most people get confused. It's really it's really growth and inflation expectations. So let me give you a quick example. Let's say you're a bank in the Cayman Islands, and on the liability side of your balance sheet, so your dollar funding, you're paying 2%, right? 2%. And let's just assume that you can match up the maturity with your deposits with a treasury. So let's say that you have a time deposit of 2 years, right? And that's $10 billion. And you're paying 2% for those dollars. How many treasuries would you buy? Yeah. The answer is limitless. Yeah, exactly. There is no limit to the number of treasuries you could buy. 2 year, you could match up maturity. If you can pocket the spread, that's all you care about. Because your dollar funding costs are 2%, but yet you can get, let's just say 4% on that treasury. You're pocketing the 2%. You don't care how many 2-year treasuries Janet Yellen issues, because you're going to buy more. And what happens is if the interest rates go up because of supply, you're just going to buy more that will bring them back down to the fundamentals as to what moves rates at the long end, which is those growth and inflation expectations. Because if you think that growth and inflation is going to be higher, then you're going to take that balance sheet capacity and you're going to allocate it to lending into the real economy as opposed to buying the treasuries, and then the interest rates go up because of that inverse correlation between price and the rates themselves. So my point is, I don't think we have a debt problem, but the problem is the spending. Mm-hmm. This is the problem. Yeah. Well, it is sustainable, unfortunately. And what I say on my videos all the time is the problem with the debt crisis is there's no debt crisis. Because if we did have a debt crisis, that would actually constrain government spending. The problem is we don't have a debt crisis, and there's going to be banks out there that are willing to buy this debt because of that spread, that dynamic. It's one of the dynamics that we just talked about. So this gives the government basically an unlimited credit card to sit out there and spend and spend and spend. And the problem with that government spending is that's what distorts the economy. Yeah. It's so a lot of people will sit here and say, well, my goodness gracious, if we could just get the government spending back down to 50% of GDP, well, that solves all of our problems, because then the foreigners are, with all this additional supply, there's going to be balance sheet capacity, there's going to be demand. No. That makes the problem worse. It's the example of the heroin addict that I always use. So let's say he's got a credit card, he runs it up to 100,000, injecting more and more heroin into his bloodstream that destroys his body and destroys his mind. And you say, well, the problem, obviously, is that he maxed out his credit card. So let's just go ahead and give him another credit card. Are you helping him or are you hurting him? No, you're hurting him because now he's going to inject more heroin, and that's the problem. The debt isn't the problem. It's the fact that he's injecting heroin and more of it into his bloodstream and destroying himself, killing himself, right? And that's the way you have to look at the U.S. economy. It's the injection of heroin. It's the government spending. It's not just getting the debt under control to where it's 50% of GDP as opposed to some arbitrary number, let's say 125 or 120%. So going back to why I'm bullish, when we get this talk from all these influential people of reducing the size of government, that's what really gets me excited because I know that's the real problem.
So spending will be cut. I mean, since July, we've added $1 trillion deficit to the 36. Like it's getting out of hand. How do we diminish that? It's not going to be just Doge.
No, and again, I don't know that should be the focus. I think the focus should be first and foremost on reducing regulations. Because this is what I'm talking about. You reduce regulations, you reduce the size of government, then you free up the marketplace to go ahead and create more goods and services. And at the end of the day, that's the real wealth in society. It's not dollars, it's not gold, it's not silver, it's goods and services, right? So if a society, can produce more goods and services more efficiently, this will increase the wealth. This will increase the standard of living. And that's a separate question from what's going on with the debt. So I think we have to focus what they're focusing on, which is reducing the regulation, reducing the bureaucracy, reducing the red tape, cutting the government employees just 50% straight across the board, I think would be a great start. And then what you're doing is you're freeing up the human, all the resources that we have in the United States and that entrepreneurial spirit, the animal spirits that Keynes talks about, you're just releasing that. And then I think you're off to the races. And I think that growth will compensate for a lot of the current problems that we have.
So how much of this, socialistic mentality that we've had, the culture that you're talking about that's now been diminished with this election, how much of that has held us back? And are we now entrepreneurs? Or is this a new, are people changing their ways about them? And is America back?
Yeah, I don't think, I want to be clear, this stuff doesn't happen overnight. Yeah. I don't think it's a light switch. But you just see the narrative change. Mm-hmm. And I think what we had is probably a lot of I don't want to call it pent up demand, but you had a lot of people that had these beliefs that allowing men to participate in women's sports as an example. I think 99% of Americans thought that's completely absurd, like ridiculous, but they were afraid to say it, right? And I think a lot of Americans said, well, I think the growth of government is completely out of hand, but they're afraid to say it, or they're afraid to say we need to cut back welfare because, well, if you're an oppressed individual, or if you're a victim or whatever, well, then we need to put you up on a pedestal. Where instead of when I was growing up, it was quite the opposite. It was the people that were successful, that were hardworking, that were out there taking risks, the entrepreneurs. Those are the people that society at large actually looked up to, right? So then you got this guy, Donald Trump, you hate him, love him, whatever. Bottom line is he has been an entrepreneur. He goes out there and he takes a bullet, for heaven's sakes. And most of the people watching that, although they'd probably never admit it, realize that probably wasn't just a result of that crazy kid that was sitting on top of the tin shed. There were probably some, let's just say, other people involved that were pulling the strings. And I think the majority of Americans would say, yeah, there's something else going on there. I don't know what it is, but there's something else going on there. Something doesn't want Trump to win. So you see this guy that's an entrepreneur and kind of representative of that spirit that I'm talking about, that spirit that we had in the 1980s, right? Which is when Trump came to prominence. You see this guy take a bullet, and then he stands up and says, "Fight, fight, fight." I mean, come on, that has a massive impact, I think, on the psyche of most Americans, whether they love him or they hate him. I mean, look at what Zuckerberg said.
I know, I was going to say, they flipped Zuckerberg just like that.
Yeah, Zuckerberg does an interview like 2 weeks later. He's like, look, I don't really like Trump, but when I saw that, he goes, that was the most badass thing I have ever seen in my life. Yeah. He goes, and I think that's why people would maybe vote for for Trump, So again, I don't want to put the emphasis on Trump. I think it's more so what he represents in the eyes of the majority of Americans. And I think you're just taking the shackles off of these people and allowing them to say, you know what, forget this crazy stuff that we've been dealing with for the last 5 years. Forget the football players taking a knee. I'm not going to support those people anymore. What I'm going to do is support the people that are now celebrating success, celebrating all of these things that we've been talking about, which I think center around the reduction of government based on what I've been hearing from Elon and Vivek in their interviews with people like Rogan and people like Tucker. And I think even if they're not able to achieve a substantial reduction in the size of the government, the fact that people are now talking about this in a positive light, I think is absolutely huge.
What are these policies going to do in 2025 to assets then? I mean, what are you looking for?
Well, 2025, I would say it's very tough where you're trying to predict price. What I do as an investor is I try to start with the question, is it cheap or is it expensive? As opposed to starting with the question, will the price go up or down? Because it takes us back to what we were saying. I don't know if we were saying this on camera or off camera, but the three main things that every great investor has, whether it's Druckenmiller, Buffett, whoever, is they, number one, control risk management. So if I'm sitting there looking at the stock market as an example at a 22 forward PE or whatever it is, I'm saying, okay, my risk management, I don't know how much of my portfolio I want to allocate. Maybe some, but I've got to be very cautious there. And then I've got to understand the macro components and what the yield curve is telling us and all these other things, understanding that there is some substantial downside. I need to protect my downside, even if you've got a portion that's long. So then you look at it and say, okay, I got to have an edge. So whether you're investing in gold, whether you're investing in silver, interest rates, you're playing that the dollar or whatever it is, you've got to have an edge. You say, what do I know that the market doesn't know? And then you've got to realize that over the short run, it doesn't matter what you think. It only matters what the market thinks, right? And then it's that delta, and then understanding when is that delta going to go, when is the market going to see what you see, right? And then you have to make those asymmetric bets. So going back to the stock market, using that as an example, do I think there's more upside or downside in the market right now? I'd say probably more downside. It doesn't mean that the stock market goes down. It's just looking at it from a standpoint of asymmetry. So I would rather look at things like gold, which I think the asymmetry there is more of what I want. Instead of more downside than upside, you've got more upside than downside. I think silver, I think the miners would fall into that category. I think uranium, a lot of the stuff that they talk about at this conference would fall into that category. But I think if you start with those fundamentals and then look at your portfolio and set up your portfolio through that lens, that you're going to be way better off.
Well, I mean, to your point, Buffett's sitting on the record cash holding that he's ever had. So he's not putting it in the market right now.
Right. And I guarantee you his number one priority, well, he's told you this, right? What are the three top investing tips? What he says? He says, don't lose money. And then number 2 and 3 are don't forget number 1. You're right. So what I'm saying there is that's risk management. That's risk management. And I think that when you look at what the curves are telling us, what interest rates are telling us, you've got to have that as priority number 1 going into 2025.
Tell me what the markets are not pricing in terms of risk for this upcoming year.
They're not pricing in disinflation or deflation. Not at all. They're pricing in the opposite. And so I know, that takes a lot of people off guard because they're saying, George, the prices of the stuff that I buy have gone up 100% over the last 3 years. You're absolutely right. But that doesn't mean that this consumer price inflation reaccelerates like it did in the 1970s. It could be the 1940s, where in 1947, we saw the inflation rate, as measured by the CPI, get up to 19%. 19. And then 2 years later, it was -2. Or it could be very similar to what we saw during the GFC. I'd like to remind people that even if you go back to the 1970s, when you saw the recessions that we had in 74 and then in 80 and whatnot, when you got that big spike of unemployment that we typically see in a recession or hard landing, the result was disinflationary. Now, again, I'm not saying that we had deflation in the 1970s. Absolutely did not. But we saw the rate of increase go down when we were in that recession. And now if we're starting at, if you want to believe the CPI at 2.6 or wherever we're starting, if you believe that the probability is high that we have a recession and the yield curve in the cycle does play out the same, over the near term, I think you've got to your base case needs to be disinflation. So that's and the market is predicting the complete opposite. Complete opposite. They're talking about Trump tariffs inflationary, and that's if they don't like Trump. They're talking about, the Fed cutting too much, 50 basis points, to your point, 25, probably another 25 here in December, and how that's offsides because we've got a booming economy and all these other factors. And, if you go out there and say disinflation and interest rates are going to be lower in a year, I think that you would definitely be a contrarian. And usually that's where you make money.
Yeah, it does. And what does that mean for commodities?
So commodities, I think you have to look at it through the lens of a commodity super cycle, and then you have to look at it in a short-term basis, right? So what commodities do over the next 6 months, I don't think is really indicative of what they'll likely do over the next 10 years. So when you look at early 2000s as an example, that was the last big commodity super cycle that we had right then. And I think that we probably were at that mark in 2020. I'll bet you if we look 10 years later, if we look in the rearview mirror, we'll say that the bottom in commodity, or especially oil prices, was when it got to negative like $38 a barrel. It was that April of 2020. That was probably, I doubt oil's going back to negative numbers. So from there, you say, okay, it's the trend is likely up, but that doesn't necessarily mean that it goes up in a straight line. Nothing ever does. So I think that you could see some downward pressure in commodity prices over the next maybe 6 months or year if that yield curve plays out. But that's going to be your opportunity to go in there and buy. Another thing I'd point out is look at the price of oil right now. Trading around $70 a barrel. It was under 66, 67. And that's with 2 wars going on, and that's with massive supply restrictions from OPEC plus. So if you take that out of the price of oil, we'd be trading at 40, 45, something like that. So that tells you that the global economy is very sick from a demand standpoint. I understand there's supply increases, but a lot of that is demand driven, right? So that leads me to believe, along with a lot of the other things that I'm saying, that we could see a downturn in the economy, which would be negative for commodities overall. But again, like we were just saying, I think that's your time to step in and buy, because you've got that asymmetry where the upside's a lot bigger than the downside.
Okay, so a little bit more fear or panic in that market, potentially. Gold could make the case study too. We saw an 18% dip right after Trump being elected. Today, it's trading above that.
Gold is really interesting, because if you believe that we're likely to have a recession, then you have to ask yourself, would we have a liquidity event? Because if we don't have a liquidity event like we had during the GFC, gold probably is still going to continue to trend higher, right? Again, with that volatility, it never goes up in a straight line. But if you have a liquidity event like we had during the GFC or the beginning of COVID, that's usually when gold sells off, because ironically, it's doing its job, because that's the only thing that has a bid. And these big hedge funds, they have to sell something to generate the cash, and the only thing that they can sell is gold, so they sell it, which makes the price drop. But again, if you look at the GFC, at the end of 2008, like we were talking about, or the beginning of COVID, when you saw that big price drop in gold, that was your opportunity.
Yeah, and one could argue, we got a new base of 2000. Do you see it going below? What's your outlook?
It depends on liquidity. It depends on liquidity. If liquidity just completely vanishes, sure, it could go down temporarily. Who knows how low that it could go. But if we did have a liquidity event to that degree, I think the Fed and the central planners would step in and try to, not that they could, but try to solve it a lot faster than they would have, let's just say, in the end of the 1980s, right? Because we're on this trend where the central planners step in sooner and sooner and sooner and sooner and sooner. And therefore, that limits the downside that you have due to that liquidity risk. You
talked a little bit about the miners. Of course, we got lots of miners here. You've been looking at it. You still think you're bullish on that case? Any particulars that you're looking at, or what are you going forward and saying, okay, this I'm going to invest in?
No, I don't have any names, because I don't really get down into the nitty-gritty and analyzing the balance sheets. You guys are much better at that, and everyone here at this conference is far better at that than I am. I just really look at the macro and look at the overall sector and say, hey, is this something that I'm interested in? And it's definitely on my watch list, but I'm not there yet. I'm not ready to pull the trigger until I see how this really plays out as far as what the yield curve is predicting. And then, once I think we're out of the woods, then I'd focus more so on the individual names. I actually did go to a gold mine the other day, though that was the first time I ever visited one, and it was quite the experience. If you guys haven't had the chance to actually go to a Colombian, well, it doesn't have to be Colombian, but a gold mine out in the middle of nowhere, it's really, really cool.
I did actually see that. I saw that you had a photo. I think you had some dollars with you. You were in Colombia with another gentleman?
Well, that's a guy that works for me, Ali, right? Because I don't speak much Spanish. But I live in Medellin, and I realized that there's this whole town where they've been mining gold for 450 years. It's about 3 hours south drive. So we actually drove down there, and I tried to do a couple live streams from these little private mines, which I'm not, Doug Casey always says that this is a choo-choo train business. My good buddy Doug Casey. And I'm sure a lot of your viewers have heard him say that. No, it's not even a choo-choo train business. It's a donkey business. I mean, literally these mines, and I'm not talking about the corporate one that's down below, but up on the mountain, there are all these little private mines where you literally have these guys just in rubber boots walking into a hole in the side of a mountain, the size of this table, and then just walking out with a bucket of rocks, putting it on their donkey, and then their donkey walks the bucket of rocks across the street, and they put it into a grinder, get it down into sand, and then a guy sits there with water trying to sift the gold from the sand, and that's where you're getting the gold that you have in that American Eagle that you have in your back pocket, right? And to see that process from A to Z is really fascinating.
Fantastic. George Gammon, thanks for joining me, man.
Yeah, thanks for having me.
Thank you. I'm Jeremy Szafron for all of us here at Kitco News. Thanks for watching. Again, we're here at the New Orleans Investment Conference, 50th anniversary, some great guests. We'll see you next time.
Kitco News, special coverage of the New Orleans Investment Conference, is brought to you by Uranium Energy Corps and U.S. Gold Mining.